Hi, sorry, I'm just having some technical difficulties. Give me a minute to join this call. Yeah, just give me 1 minute. I'll try to rejoin. All right. I think we can wait for 1 more minute and see if anyone else is joining, and then we'll begin the webinar. So, first off, thank you for joining on time and allowing us to start on time. And happy Women's Day to everyone who's on this call. I'm sure there's someone who's inspiring you and someone who's uh, been able to make a positive difference in your life, who's worth celebrating today. And the context behind the topic for today's webinar, of course, was to look at how we can simplify investing for women, because there is an urgent need to sort of address this question of investing, right? There are a lot of data points, and we will go through some of those interesting stats in this webinar about how women fare as investors and what we can do differently. All right. So I don't really see more people coming in. So let's start without wasting more time. I'm happy to take any questions that you have. Feel free to type them into the chat box or in the Q&A section. And probably at the end of the webinar, we can address this. So I'll try to keep this as interactive as possible. And we will keep a significant amount of time for Q&A towards the end. So the first question that comes to mind is that we have to sort of look at personal freedom. Right? So what is this elusive thing which is personal freedom? And I think the path to personal freedom is pretty clear, right? Sorry, is my screen visible? Can you see the text? All right. Okay, so the path to personal freedom is actually dependent on financial freedom, right? And a simple way to think about this is there are many choices that we want to make in life. It might be related to a career break. It might be related to buying a house at a particular point in time. It might be related to settling down. But all of these things have a financial element to that decision making. It's not, at the end of the day, just a personal decision, but the ability and the quality of those decisions definitely influence the quality of our lives. And the freedom to make these depends on how confident we are with the financial aspect of these elements. So, where does financial freedom actually come from? It comes from investing. There's a common misconception that if you're saving, you're going to be all right, but only if your wealth is growing are you actually going to be able to meet larger ambitions that you have in life. But the problem today in today's world is that when you start chasing returns, this whole concept of high return investing could actually go very wrong for someone. So then what is it that women tend to do in this situation? They recognize that there is a gap. They recognize that there is this goal of personal freedom that they're chasing. And they know that the path from where they are to where they want to be depends on how they're able to create wealth, right? And because a high return strategy can go really wrong, you tend to stick to the safer and more predictable ways of investing. And here, there are actually a lot of risks because this means that we end up in the wrong sort of products, right? And the wrong sort of products could be things like chit funds. And chit funds are unregulated. They do give us a guaranteed level of returns, but they're not really the kind of things that can help us grow wealth, right? It is actually much riskier to have a guaranteed level of return in an unregulated product versus a variable return from a regulated product. So when we look at, say, chit funds versus funds that are regulated, whether they're mutual funds, PMS schemes, or AIFs, then there is a certain level of growth as well as security from a regulatory standpoint that comes in there. Then you have these gold schemes. So what tends to happen is you might go to a jewelry store to pick up something on a particular occasion, but then you get dragged into this cycle of investing in gold. And you're actually investing in physical gold. But when you do this, you're paying a lot more than you would for gold price returns, right? On one hand, you have making wastage. On the other hand, you have storage costs. And you don't actually recover this. So you could lose up to 8 to 10% or even higher in terms of your value of how much you're buying versus what you're paying for. And of course, when you convert something into jewelry, there is a certain use as well as sentimental value that's associated with it. And we tend not to treat it as an investment with the level of detachment that we should ideally be giving to our investments, right? Investments are here to create wealth for us. They work in certain time frames. And when that period is over, we actually have to harvest what we want. When we deal with physical assets, whether it's on the gold front or on the real estate side, there is a tendency to get attached to these things as opposed to using them purely to create wealth. Then, when we move on, I think the next obvious choice is the fixed deposit because it gives you this sense of security. You know exactly how much return you're going to earn, and it's a very predictable source of income. Uh, for those who want to save regularly, the next thing that gets pitched is a recurring deposit. But if you look at the difference between your FD and your RD itself, RDs actually don't make that much sense for an investor. Moreover, when you look at what your recurring deposit can do versus like an SIP in mutual funds, you'll realize that maybe the SIP could actually do much better for you in that context. And last, but of course not least, is your post office savings scheme. Again, here you have a variety of options which are either in terms of their nature, it's either like an FD or it's like an RD. The most attractive thing here is that you get a guaranteed sort of return because you know your return in advance and you're able to lock into this return for a fairly reasonable time. And that is helping you compound and grow your wealth. But when we move on, what we realize is that you're actually going very slow in this journey. And this story is not like the hare and the tortoise, right? You don't win the race by being slow and steady. You actually run a very serious risk of losing the race when you're going very slow. We have to think about what we want to achieve and how we want to achieve this. And it can't be through this old school manner of doing RDs and FDs simply because the market has moved so much. If we look one generation behind, maybe it made sense to have fixed deposits and recurring deposits because you could earn double digit returns from those instruments in the safest possible manner. Bank FDs would give you that kind of return expectation. But today, that's not the case. So, an investor really does need to look outside of these avenues into new age avenues, which can give you that kind of wealth creation. And if we fail to do this simply because we don't understand these asset classes or because we don't understand why returns are lumpy or why we tend to lose money temporarily and we can't tell this distinction, we might end up feeling more like the fox and the grapes, right? We know this story where you had the fox which tried to reach a set of grapes, but it wasn't able to. And then it just declared that the grapes are sour and it walks away. So we can't walk away from this opportunity proclaiming that the rest of the investment universe is sour and doesn't really work for a conservative investor who's trying to create long-term wealth. So what we need to really do is to get out of our comfort zone, to increase our ambition levels, and to increase the kind of wealth creation targets that we want. So when we're able to do these things together, then I think what happens is that you actually end up achieving a lot more than you plan to. When you achieve more than you plan to, you're actually prepared to be financially free. When you're financially free, it increases the amount of personal choices that you have. And when you're able to fulfill your personal ambitions, then I think you're home, right? So there's this cascading effect of positive things that come out of taking charge of your finances. It's not an overnight journey. If you start today, it's going to take you a few years to figure your way around. You will experience a whole cycle before you're confident about making certain decisions. And I think that's part of the natural process. And the earlier we begin this process, the more likely we are to be able to achieve something out of this and create the kind of wealth that we really need to feel secure, confident, and content with the kind of lives that we're leading. So let's talk about the good part, right? What is it that's actually working for women as investors? I think, firstly, we are better savers. The data very clearly shows this. In every household, no matter who controls the purse strings, it's the woman who sort of ensures that the saving occurs, right? You're always looking for the best deal. You're always trying to make sure that things fit into a budget. And we're always very conscious. Even if we choose lower risk avenues, I think it's quite obvious that women make the effort to sort of save more. And let's look at some data. So Amphi published a very interesting set of data points on trends in the mutual fund industry in terms of savings. So the first data point that I want to look at is how women are actually long-term investors. And for your benefit, I've highlighted the second to last row. And the way we're going to read this table is that we're going to look at how men and women behave between 2019 and 2024. So that's a span of 5 years, right? So if we see how women were investing in 2019, about 40% of them would have investments running for less than 1 year, right? In the last 5 years, there's been a dramatic shift. So that number has dropped from 40 to 25%. Similarly, if we move down the ladder, you see that as we increase time, you're seeing more and more women move into this longer term bucket. So in 2019, only about 9% of women were invested beyond 5 years. But if we fast forward to 2024, you see 20%. So you're more than double, right? Of women investors have chosen to stay invested for the long run. And when we compare this with how men have been investing, they're definitely a little bit behind, because if you look at those numbers, they were 8.2% in March 2019 versus women at 8.8%. And in March 2024, they're about 20%, whereas women are above 21%. So there's a so men are actually lagging here. And the true magic comes in when you stay invested for a long enough period of time. And it's not about, your 1 year returns, because 1 year returns can be extremely good, quite underwhelming, or even negative. So the 1 to 3 year bucket really doesn't say much about how much wealth you're creating. But if you stick to something beyond 3 years and you're able to commit and stay invested and you're able to reap the benefits of the investments that you're making, the magic really starts happening in the second half of a decade. So this is a very encouraging data point. And we can also look at whether women are more consistent, right? And when we try to answer that question, there's an easy and interesting way to sort of look at whether women are more consistent. So if we look at what kind of investments a woman is sold, we can try to understand whether they are considered to be more consistent savers or not. So if you've ever been sold ELSS funds through the SIP route, that requires a monthly commitment from your side, then it's more likely that women have been marketed this than men. Similarly, if you've been sold a recurring deposit from the bank, again, we talked about the difference between recurring deposit rates and fixed deposit rates. There is no, for the minimum amount that you need to contribute, you could do either an RD or an FD, but FD rates turn out to be more competitive than the RD rates, right? So why is it that you have more women investors who are participating in the recurring deposit space? Similarly, if we look at chit funds, it's predominantly women who opt for chit funds, right? And this is an unregulated space. There are a lot of risks that are involved in taking up these investments. So it makes sense to sort of think about what we're getting in terms of per unit of risk, and not just what is my fixed return that I'm going to earn in this period of time. And we talked about goal saving schemes as well. So the idea that a woman will save month on month, will manage a budget and keep something that she can contribute towards long-term savings comes from the kind of investments that are marketed towards women. So another encouraging sort of data point that we're going to look at is that women are actually taking more control of their finances. And this again is from the Amphi report that has come out. So if we look at how many women investors have moved to direct between 2019 and 2024, the numbers really speak for themselves, right? So if we look at each age category. So young investors under 25, about 15% of them were in the direct plan in 2019. That number has shot up to 21% in 2024. If we move one age category upwards to young working professionals, then here you see about 16% of women were invested in the direct plan in 2019, and that has grown to almost 30% in 2024. Uh, in the older categories, I think the growth has been much more muted. So if you see, say, your pre-retirement category of 45 to 58, about 13% of women were in the direct plan, and now they're about 17%. So still under 20%. And if we move to your senior citizen or that kind of category, then again you see that you started out at a slightly higher base of 14%, but you're still only about 17%. So clearly, when a woman is choosing to invest in the direct plan, she's taking control of her finances either through a platform or through an advisor, or um, in terms of managing it herself. So when that's happening, that shows that there's an inclination to actually take that initiative and to make that difference in our own lives. And this is a positive sign. But being in charge of your finances can also be intimidating. And that's why we need to think about whether we're making the right choices or not. Working with an advisor or working with a distributor is a personal choice. What is more important is how much can you commit in terms of time and knowledge to managing your own portfolio, making the right investment choices. And when you are clear about what you can do, then you can decide what the role of someone else in your ecosystem is. If you feel that you're able to manage all of these responsibilities on your own, and that you're not afraid in even the scariest markets like how markets are today, then I think you're perfectly on the right track. But whenever we have second thoughts, it's important to address them and find a solution. And the solution can't be to stay out of the markets. So if we see how women are showing up also in terms of large numbers, I think here you see that 1/3 of investors are actually women, right? And this is great because it's not just about how many women are participating, but even if you look at data that has come out in terms of what the minimum investment is in terms of SIP or lump sum, it turns out that women actually are larger contributors to savings than men, right? So the average contribution is much higher for a woman than it is for a man, even if we occupy less of this pie chart. So now we've talked a lot about the facts and the numbers and the stats in terms of what women are doing differently, how they're taking control, how they're actually contributing more to this pie of savings. I think it's important to now move to the next part of our presentation, which is how do we actually simplify investing for a woman? And I think there are a few things, right? So the first is that you want to be able to transparently measure what you own and see what is working for you and how the big picture is, right? The biggest risk in terms of having this haphazard or having small investments in different places. Let's say a typical person might have a recurring deposit running. They might have some sovereign gold bond schemes that they've bought. They might have some tax saving mutual funds. They might have a ULIP or two. Beyond that, they might hobby pick some stocks. So when you look at this portfolio, it's a little bit all over the place, but it's very common for people to create wealth like this. But when you want to measure performance, not everything allows you to measure performance, right? So if you're looking at a stock portfolio, then it's very clear that the stock portfolio will give you a clear return metric. If you have a mutual fund portfolio, it's going to give you another return metric. But just the absolute level of return is not enough for you to judge whether things are doing well. What if you've not positioned them correctly? In the sense, if you had 10 lakhs to invest and you put 10,000 rupees in your stock portfolio, but you put 5 lakhs in your mutual fund portfolio, your stock portfolio is doing really well, but your mutual fund portfolio is not, then you're really not position sized correctly. right? So the idea of having all of your assets in one place that is easy for you to measure would be a winning idea. Simply because it's easy for you to see what's happening, it's easy for you to get an overall picture of how things are doing, but you're also able to drill down and look at the details and see what is performing and what is not performing, where you need to put more time and effort into understanding your expectations and setting the right kind of expectations. The next thing that we want is a flavor of everything, right? So as we become more sophisticated as investors, there is this desire that we want to own different things. We want to have some exposure to precious metals. We want to have some exposure to global stocks. We want some security in terms of fixed income. We want some growth in terms of equity. So all of these desires, when they're there, and we tend to take random decisions in our portfolio, then we get that flavor of everything, but it comes at that cost of being able to measure things easily, right? So you want a flavor of everything in one place. But more than all of this, I think what we all want is a smooth ride. We don't want to worry about how much our portfolio has fallen. We don't want to worry about whether this is the right time to invest, whether this is a time where we have to step back and take a call and come back into markets a little bit later. So, when you want a smoother ride, then you need a little bit of math to help you take that forward. And we will talk about what that math is. At the same time, just because we want a lower level of risk doesn't mean we want to compromise on returns, right? So women actually have to find this way of making more without taking more risk. And there are some tools that we can use to get to that answer. And you also want a strategy that allows you to participate, meaning exactly what I said earlier. You don't want to be thinking about, is the market down today? Do I need to put in a lump sum? Oh, the markets have moved up in the last couple of months. Does that mean I can't invest anymore? So you don't want to keep timing the market because a very interesting study actually shows that timing the market contributes almost nothing to your portfolio. I mean, explains nothing in terms of portfolio variation of returns. Meaning, if two investors started at the same time, what are the things that determine why one investor's different returns are different from another? The idea is that when you time the market or what stocks you pick actually contribute to less than 10% of those uh, returns. What makes the huge difference is the fact that you've got an asset allocation. So your asset allocation strategy is the one that defines what your best and worst outcomes are. So moving on to what the solution could be, right? So the solution is multi-asset investing, and that means you have to have a little bit of everything. So you want to have a little bit of precious metals, you want to have some global exposure, you want to have some equity or stock exposure. At the same time, you want something more conservative like fixed income. And you might want something like arbitrage where you're getting some level of growth, but very minimal downside sort of risks. So when we're in this framework, what we really need to think about is how can we beat volatility? That is, how can we make that bumpy ride a lot more smoother? And one way to do this is through mathematics. And mathematics allows or introduces us to this wonderful concept known as correlation. So correlation essentially is the relationship between two assets in a portfolio, right? So when correlation is positive, these assets, their values increase or decrease together. When correlation is negative, the value of one asset can be increasing while the other asset can be decreasing. So what you want in a portfolio is uh, a composition of assets that are not fully positively correlated with each other. Ideally, if you can get negatively correlated assets, that gives you a wider range of scenarios in which at least one engine is firing for you. And when you have this negative correlation, your risk reduces, right? Because your portfolio can perform in a wider range of scenarios. You're able to generate some positive return from some engine at any given point in the market cycle. And your level of predicting things has to reduce, meaning you don't need to worry about what's going to happen because your portfolio will take care of itself. So let's look at how some assets are actually correlated with each other. And this is data that came out from Bandhan Mutual Fund, where they've published the correlation coefficients of certain asset classes. So if we look at the Nifty 50 versus your global, which is your MSCI ACWI, there's a correlation of 0.26, right? So the maximum correlation you can have is 1, and the minimum correlation you can have is -1. So 0.26 actually is a low positive correlation. Negative zero point 0.3, which is Nifty's correlation with gold, is even better because that means you have assets that are moving in opposite directions. And then you have pretty much a low correlation with debt. So if your portfolio just contained these four asset classes, they already work in a great way together because they don't really work at the same time. So if you look at gold's correlation with, say, the global market, then there you have a negative correlation. If you look at global market correlation with debt, that's also a low positive correlation. If you look at debt's correlation with gold, again, there you have 0.22, which is again a low positive correlation, right? So bringing all of these things into one portfolio can actually make a difference. And let's look at why you need that, right? Why is it that you actually need a flavor of everything? And does asset allocation actually really work? Does it make sense to have a little bit of everything in your portfolio? And the data again shows us that it makes a lot of sense to have a little bit of everything. Why is that the case? Let's look at this chart. It's quite interesting on its own. And the way to read this is each box represents one asset class and each color represents a particular asset class over a period of time. And what we've done here is we've ranked your assets from the highest performer to the lowest performer from 2010 to 2024. So this is 15 years of data, which is published by LiveMint. And when we look at this data, what stands out? I think there are three important lessons here, right? So the first lesson is look at the bottommost row and look at, you'll see some years where the bottom row is negative, right? Now look at the topmost row and you'll see that in all years, your topmost row is positive, right? And this essentially tells us that there is no year in which all your asset classes are going to fail you. There's always one engine which is firing, no matter where you are or which year you pick out. There is always something that's working well for the investor. Now let's try to look at the second lesson, right? So we're looking at the bottommost row, we're looking at where the numbers are negative. So count the number of years in which the bottommost row has a negative number. And if you take a minute or so to do this, you'll realize that in the last 15 years, 7 years, you're seeing a negative return in the bottom row. 8 years, the return is positive, which means that about half of the time, all of your asset classes are contributing positive returns. Whether they are low positive returns, high positive returns, that's a different thing. But you're not making a loss on this portfolio, which is the most important lesson. Then we get to our third thing, right? So this quilt looks lovely in front of you because it's so colorful. But let's try to make sense of some patterns in these colors, right? So if we look at, say, the time period from 2013 to 2017, right? What's happening with gold? So you see that 2013 gold is at the bottom of the pile, right? So 13, 14, 15, very bad years for gold. 16, somewhat good year. 17, very dull. Now, let's look at the next 5 years, which is 2018 to 2022. And here, if we look at this, gold has pretty much been top of the charts through this segment, right? So when we start paying attention to these patterns, we can pick up any other asset class. So if you want to look at small cap, let's look at that cycle. Again, here, we're going to look at the gray boxes. So if we see the last 5 years, right? So 24, 23, 22, 21, 20, small cap has pretty much been at the top of the cycle. You've had one bad year in 2022, but apart from that, you've made upwards of 20% returns over the last 5 years. Then if we go back a couple of years in time, you will see that you had a drawdown in 2018 and 19, and you had a fantastic year in 2017, but you had a very mediocre year in 2016 and 15, right? So there is this up and down movement, and you do see that winners become losers, losers become winners. And when you understand that there's a cyclical nature to return generation, I think it also prepares you to look for the next opportunity and not just pay attention to what has worked well in the last couple of years. So, quick recap of our three big lessons. No year does everything fail you. Um, the second is heads you win, tails you don't lose too much, because half the time all of your assets are actually working for you. The third important takeaway is that we need to cultivate resilience, right? Because losers can become winners at any point and winners can become losers. And there is a cyclical nature to how we earn returns. So, how can you get everything in one place? We've understood that asset allocation works. We've understood that correlation is a great, powerful tool. And so, how do we actually bring everything into one place? And there are two ways for an investor to do this today. I think one is that you can create a portfolio of mutual funds simply because mutual funds are a great tool in terms of getting that kind of asset allocation that you need. You want global exposure, there are global funds. You want conservative debt exposure, there are conservative fixed income funds. You want aggressive fixed income exposure, there are aggressive fixed income funds. You want equity exposure, you have a wide variety of choices. You want to be more aggressive, you can get into thematic mid and small cap funds. You want to be less aggressive, you want to be more cautious, you can do uh, blue chip funds. You can even get into index or passive investments, right? So I think anything that an investor desires, all of those flavors that they crave, can actually be achieved through a mutual fund portfolio. That's one great way to sort of do it. And if you keep everything within one platform or one service provider, your entire reporting will happen for that whole portfolio. So you don't need to worry about measuring these things in different angles or aspects. You get a security level breakdown, but you'll also get an overall portfolio view. And I think that is good enough for us to measure and see how things are doing. So the second option that we have is that you could work with a portfolio management service, especially because SEBI regulated PMSs can come up with multi-asset strategies that work entirely for the investor. And now that you know these two parts that are available to you, probably the question that you're asking is, okay, do I have to do this by myself? Like, do I have to navigate this entire process on my own? And the answer is that it's really in your hands to decide how much you want to take on, right? If you enjoy this, then by all means, work by yourself. Enjoy this experience of creating wealth. Indulge in your learning journey, but if you feel that somewhere you don't have the bandwidth or you want a little bit of handholding, then we are also here to help you with that journey. And we have a few very interesting initiatives in the form of Milestones to Wealth and Kodishwari, where we work with investors to go from wherever they are to their first crore in financial savings. Kodishwari, of course, is a exclusive program for women, whereas Milestones to Wealth is open to both men and women. We have products also that you could participate in, and the products are SEBI registered PMSs. So you have Sphere as well as Neo. It's a flat fee product, so you pay 1.5% per year. And it's a multi-asset strategy, of course. Sphere is for resident Indians, Neo is for non-residents. And because it's a SEBI registered PMS, your minimum investment is 50 lakhs. So we've done reasonably well as well. And I think before we close, I'd just like to say happy Women's Day to everyone. It's been great to be part of this conversation, and I'll open it up for any questions that we have. And if you have anything that you want to discuss with us on a one-on-one basis and you don't feel comfortable sharing it in a webinar forum, you could always drop us a quick message on WhatsApp at 9500027285. And the number is also available on your screen for you to go through. So I'm happy to take any questions that we have at this point. Is there any SIP method for kids higher study, like 7 to 10 years and milestones to wealth? Yes, of course. So please discuss your goals with your advisor, and they will be able to assist you in creating a corpus separately that can also report separately in your portfolio statement. So if you want to set a 10-year goal, whatever that amount may be, we can help you map that as a separate investment goal. So when you're looking at your portfolio statements, you will actually see this as um, your child's education goal, and it will not be something that's clubbed in with everything else. So that level of goal mapping can be done, and with a longer timeline you can also modify your risk appetite for that particular goal if required. So feel free to type in any questions that you have, because I think we're a small group today, and uh, we have about 15 to 20 minutes where we can get into Q&A. So I think it'll, and I'm sure there are some questions on our mind which can actually benefit other people also in the room today. So anything that's on your mind that you want to discuss, whether it's about markets, whether it's about products, or your personal experiences, I think we have the time to go through all of this today. I see a couple of people typing. Okay, so I think while people are typing, I would just like to thank those of you who are here today and wish you a happy Women's Day once more. And just in case you're interested in Milestones to Wealth or in the Kodishwari program, or if you're just keen on seeing what we have to offer on the PMS space, please feel free to drop us a message at 9500027285, and our team will get back to you. Right? So, okay. So, question: how did you end up in the finance sector? What's your personal experience? If you are willing, could you please share? Sure. So, actually, I ended up in finance quite accidentally. To be honest, I was studying mathematics in my undergrad in college, and one of my seniors from school, she was studying economics, and she had just finished her internship with Goldman Sachs, and that was happening in Bangalore. So she came back and she told me that, when I get the opportunity, I really need to apply for that internship and get into that role. And I knew that Goldman Sachs was a finance company, but I didn't know much about what they did. So I was a little bit like very underprepared, and I felt that, oh, I don't know anything at all about this. Um, so maybe I should be working on something. Maybe I should try to figure out something and be prepared for that job, even though it was just an internship. And so then I think slowly I started reading and getting involved in that sense. And as that developed, I got a full time offer from Goldman. I worked with them for about a year. And I realized that that was not, I mean, for me at that point, finance just seemed like finance, right? I didn't really understand that there were different roles that you could assume, meaning that investment banking is very different from, say, asset management and those kind of things. So only through that first year of work, I realized that there are many other roles. And I also realized that I would like to work more with people and not just on the money angle of it. And so that's how I came to know about iThought, and I've been here for the last 9 years. That has been my journey because I think I've gotten a lot of personal satisfaction as well as learning in this journey of my career. Okay, interesting question. How to stay updated about the market and finance on a daily basis? I think how you can stay up to date is one, like, keep in touch with the news. Um, that helps a lot. But see, it depends on what your goal is, right? If this is your job, then it's important to read the news. It's important to participate in a lot of these things. It's important to understand what other fund managers or product managers feel. You need to keep in touch with like macroeconomic data, so things that the government or the RBI publishes, reading opinion pieces, getting industry views. These are all part of the job if this is your job. But if you're an investor, I think some of this can actually be quite counterproductive to what you're doing, because we tend to limit our access only to newspapers, right? And newspapers have a way of sensationalizing basic things. So for somebody who's just an investor and not someone who's a finance professional, a lot of the headlines can actually be quite scary, right? So when you start digging deeper and you look at the details, you might feel that, okay, maybe a lot of this is just more drama than things that I need to worry about. So see where you are on that spectrum, because the most important thing for an investor is that you should enjoy this journey, right? You don't want to be in a product that makes you worry about what you're doing. You don't want to be in a product where you're stressed about what's going on all the time, or that makes you check your portfolio regularly, because these are the things that trigger us to take certain actions which are unnecessary. And when we take these unnecessary actions, we are the ones who are destroying wealth, and we are the ones who are dealing with those consequences. So, if you're not in this line of work, I think a more balanced approach in terms of staying in touch, like, yes, it's important to read the papers, keep up to date with what's happening, know where to anchor your expectations. Those are all fine. Talk to your advisor. I think every once a month is good enough. Make sure that you're checking your portfolios and rebalancing once a quarter, right? So seeing where there are opportunities, what you can do. I think that if you change the nature of your portfolio maximum once in a quarter, that is more than enough, right? You don't need to do it every month. You don't need to do it every week. You don't need to respond to everything that you see that's happening in the market, because the market is a very noisy place. Um, so that would only be the kind of recommendation that I have. Happy Women's Day to you, madam. What type of investment will be suitable for people in their early 40s? I think definitely multi-asset investing is suitable for someone in their 40s. The simple logic being you will retire in the next 15 to 20 years, right? And this is a journey where you want to have a lot more predictability in terms of how your portfolios turn out. You want to prepare for retirement so that by the time you get to retirement, you're actually able to withdraw money on a consistent and regular basis. So the choice of how you want to do that is definitely up to you, right? We can take a fragmented approach, which is what most people have, where they have uh, some assets here, some assets there, something with the bank, something with certain people. That is harder to measure. Uh, If you want a more clear, transparent option, if you have the ticket size of 50 lakhs and above, you can consider a PMS. If you don't have that ticket size and you want to get there over the next 15, 20 years, then I think you should definitely start at least with the mutual fund category. So the vehicle or the tools that you use will depend on your choices and circumstances. But definitely multi-asset investing should work. And I think if we're also talking not just from an age perspective, but a market context perspective also, I think today multi-asset investing is a great place to be in. You're most welcome. Thank you for asking these questions. I think it's very clear that people have put in a lot of thought before typing anything. So thank you for being so thoughtful and patient in terms of what you're asking us. I hope my answers are also helpful and are giving you what you need to think about. Kodishwari is our program which we're running exclusively for women. So what we do is we have workshops, we have webinars, we have certain education initiatives along these lines. The basic idea is to get women to take control of their own finances, right? That is the key message that is there in that program. And we feel that the gap in a lot of places is mostly like a confidence gap, that they are worried that certain decisions that they are taking may not be the best decisions, especially because when you are investing in the market, right, a negative return does not mean that you've taken a wrong decision. Similarly, a positive return could mean that you made the wrong decision also. So return cannot be a metric that we use to judge whether we are doing the right thing or not. We have to go beyond that. But for someone who's not experienced a market cycle or who does not know how the industry works, um, the return becomes the obvious way to measure our decisions, right? So, Kodishwari is about helping you find the right tools, making sure that you're able to secure your finances, giving you the knowledge and the confidence to build your own wealth creation story. And we do this primarily through mutual funds for investors. So, for somebody who wants to start out, it doesn't matter. So in that program, we work with a wide range of women, right? So we work with people who are homemakers, we work with people who are self-employed, we work with salaried women. Some of them are very young in their early 20s, some of them are older in their 40s and 50s. But the basic idea is we want to work with women, we want to help them feel good about their relationship with money, and we want to move them towards that 1 crore target in a manner that they feel comfortable in traveling that journey, right? Nobody's pushing you anywhere. You have the full uh, control in terms of direction and speed. And again, if anyone is interested in Kodishwari, you can just quickly drop a message to 9500027285 saying that you're interested in knowing more about the program. And definitely someone from our Kodishwari team will reach out to you in terms of uh, what we can do next. A lot of our educational initiatives are actually through webinars, ma'am. So if you follow us on social media, whether it's YouTube, LinkedIn, Twitter, wherever you're present, you can always see what we are posting. And almost every week we do 3 to 4 webinars. So whether you're not, I mean, whether or not you are in Chennai, you can definitely benefit from the educational initiatives that we have. And that calendar will be available on social media. So, and pretty much all of our webinars, after we record it, is posted on YouTube as well. So if you want to go and see some of the webinars that we've done before, that entire content is available on YouTube. So you can look at I Thought Connect or I Thought PMS, Milestones to Wealth, or Kodishwari. All of these channels are available online. So you feel free to browse. Subscribe if you'd like to be part of future education initiatives, because we put out a webinar calendar every week, so you can see what is in store, and you can register for whichever webinars you're interested in. Kodishwari, of course, there are in-person workshops. Maybe if you're not in Chennai, that might be something that we won't be able to attend. But we can always work around that, because the webinars cater to people who are not close to where we are. Are there any other questions that anyone has? I'll just give it another minute and then we can close. I'm sure all of y'all will want to be celebrating Women's Day with somebody, or just taking it easy as well. So I don't want to take up more of your time. All right. So I don't see any other questions coming in. Uh, I want to wish everyone a happy Women's Day and have a great weekend. We hope to see you in one of our webinars soon. And if not, and if you're interested in working with an advisor or a professional, then it would be our pleasure to work with you. So please do feel free to drop a message to us on WhatsApp and we will get back, and look forward to our next interaction. Thank you so much.